Decoding the crystal ball. Harnessing economic leading indicators to anticipate market trends and shifts. In the labyrinth of financial markets, investors often seek a crystal ball to peer into the future, anticipating market trends and shifts before they unfold. Enter economic leading indicators, the compass that guides astute investors through the intricate maze of economic landscapes. Understanding how investors can harness these indicators to forecast market trends is akin to wielding a powerful tool that transcends conventional wisdom and taps into the pulse of the global economy. The essence of economic leading indicators. Economic leading indicators are metrics that provide glimpses into the future trajectory of economic activity. These indicators precede changes in the overall economy, offering investors early signals about potential shifts in growth, employment, and inflation. By examining the trends in these indicators, investors can gain valuable insights into the health of the economy and position their portfolios strategically ahead of broader market movements. Unemployment rates, a harbinger of economic health. One of the pivotal leading indicators is the unemployment rate. As the job market represents a vital component of economic vitality, changes in unemployment rates can signal impending shifts. Rising unemployment rates may indicate economic contraction, prompting investors to adopt a defensive stance by reallocating assets away from cyclical sectors. Conversely, declining unemployment rates often precede periods of economic expansion, encouraging investors to tilt towards growth-oriented investments. Consumer confidence, the pulse of spending patterns. Consumer confidence surveys offer a window into the mindset of the general populace. When consumers feel optimistic about the economy, they are more likely to spend, stimulating economic activity. Monitoring shifts in consumer confidence can thus serve as an early indicator of changing spending patterns. As consumer sentiment rises, investors may consider positioning their portfolios towards sectors such as retail and consumer discretionary, anticipating increased demand and economic growth. Manufacturing index. Gauging industrial momentum. The Purchasing Managers' Index, PMI, and other manufacturing indicators are crucial leading indicators, providing insights into the health of the industrial sector. A rising PMI suggests expanding manufacturing activity, indicating potential economic growth. Investors keen on anticipating market trends may favor sectors tied to manufacturing, such as industrials and materials, as these are likely to benefit from increased production and economic expansion. Yield curve inversions, a harbinger of economic storms. The yield curve, which illustrates the relationship between short-term and long-term interest rates, is a harbinger of economic storms when it undergoes inversion. Traditionally, a yield curve slopes upward, with longer-term rates higher than short-term rates. However, when this relationship flips and short-term rates exceed long-term rates, a yield curve inversion occurs. Historically, such inversions have often foreshadowed economic recessions. Investors attentive to this indicator may adjust their portfolios, adopting a more defensive posture in anticipation of economic headwinds. Housing starts. Building the foundation for economic growth. The housing market, intricately tied to economic health, provides another lens through which investors can anticipate market trends. Housing starts, reflecting the number of new residential construction projects initiated, can signal shifts in economic momentum. Increased housing starts may indicate a robust economy, prompting investors to consider sectors like construction and homebuilding. Conversely, a decline in housing starts might herald economic slowdown, leading investors to reallocate assets towards defensive sectors. Leading indicators and investment strategies. Investors can weave economic leading indicators into their investment strategies by adopting a proactive and adaptive approach. For instance, during periods of economic expansion signaled by low unemployment rates and robust consumer confidence, investors may favor growth-oriented sectors such as technology and consumer discretionary. Conversely, in the face of rising unemployment and waning consumer confidence, defensive sectors like healthcare and utilities may become more appealing. Moreover, savvy investors understand that economic cycles are inevitable, and timing is crucial. By leveraging leading indicators, investors can potentially identify inflection points in the economic cycle, adjusting their portfolios to align with prevailing market trends. This proactive stance allows investors to capitalize on emerging opportunities or safeguard their assets during periods of economic turbulence. Conclusion. Economic leading indicators serve as the crystal ball that enables investors to peer into the future, providing valuable insights into the twists and turns of the economic landscape. Armed with an understanding of these indicators, investors can anticipate market trends, positioning their portfolios to capitalize on emerging opportunities or navigate potential challenges. While no crystal ball is infallible, the strategic use of economic leading indicators empowers investors to be more informed, agile, and responsive to the ever-evolving dynamics of the financial markets. It is a potent tool that, when wielded with insight and diligence, can enhance an investor's ability to navigate the unpredictable journey of market trends and shifts.